Welcome to the Founders, Funders, and Friends podcast, where we interview entrepreneurs, investors, and the innovators building the future. Each interview features a special guest in conversation with studio management founder and managing partner Alap Shah, recorded in front of a live audience in New York City. Founders, Funders, and Friends is presented by Studio Management, a data-driven asset management firm investing across public equities and venture capital. Who co-founded the startup Erly, served as head of product at Flipboard, and led the video team at Oculus. Currently based in New York City, Eugene is working on new ideas at the intersection of media and technology, while also advising and angel investing. Joining Eugene is Oana Olteanu, a partner at early-stage venture capital firm SignalFire. With a focus on seed and Series A companies, Oana specializes in AI, developer tools, and infrastructure. She has been instrumental in investments like Fixie, Explosion, and Kurtosis, and was recently named a Rising Star by Venture Capital Journal. Oana is also the founder of She's Ready To.dev, a community supporting women in tech. With a background in machine learning engineering and a deep understanding of the software stack, Oana brings a wealth of knowledge and experience to her role at SignalFire. On this episode, we explore the journeys of Eugene and Oana, delving into their contributions to technology and investment. Please join us in welcoming Eugene Wei and Oana Olteanu.
I figured the easiest way to start is just talk a little bit about the market environment and what we're seeing, considering it's been a pretty tumultuous couple of years. So I'd love to open it up to either of you in terms of what you're seeing today, in terms of what you're investing in, how things it seems like things are certainly turning a little bit versus a year ago. But would love to understand a little bit about kind of what you're seeing and how some of the founders in this room could internalize that information in terms of their process and especially their sort of capital plans.
Yeah, happy to share some insight from how it looks like from the investor side. I believe many of you follow maybe like Twitter or LinkedIn, are on social media, and maybe you feel a bit of, especially for the founders in the room, doom and gloom. Like if you're not in AI, it's super hard to raise, and even if you're in AI, maybe VCs are not doing deals. I think that's not accurate. I think now is the best time to start a company and raise. And that's because there are a lot of solo capitalist VCs who are writing checks in this market. So you could access capital even from a smaller fund. There is a lot of talent out there. And a lot of these funds have been trying to conserve the money they've raised from LPs. And yes, they are much more diligent in terms of looking if there is a competitive advantage to the business and not maybe just like an API with like a thin wrapper on top that anybody could do. So they do more diligence, but they still very much are in the business of deploying the capital, and it's a good time to raise. In terms of what do we see in market, I must say that I'm a developer tools investor, so I'm more on the infrastructure side. And there are a lot of companies who are raising who are not necessarily software, but more professional services. There's smart people who maybe dropped out of FANG, who maybe played with some of the APIs from OpenAI and are trying to raise some money. And I believe that's because for the past couple of years, especially in 2021, it was much more easier to raise and be a founder. And that's determining the noise that you see that everybody's now raising for an AI company. But there are also indeed less founders who raise from first principles, but they do exist. So the first principles still apply in terms of fundraising. So we're seeing a lot of on the foundation layer. If you think of the stack, you have the foundation models at the bottom, you have some middleware, dev tools, and then you have some applications on top. And the foundation model layer, it's very expensive in terms of data and compute. So we see less startups fundraising there. And frankly, less VC firms deploying money there because you would have to have a huge fund to back such a company. So that's more for big tech. All of these like OpenAI, Cohere, they are backed by a big tech company behind them. And the middleware layer, we see a lot of tools, but we see a lot of tools who try to capture 100K contracts for, let's say, a feature store or modeling or a small part of the development lifecycle. And that's a lot harder for a customer. A customer doesn't want to spend a couple of millions to be able to have a working machine learning platform. So those are some of the things we're seeing. And I think the market is waiting much more for a bundling solution where you just pay 100K and it solves all your machine learning platform needs. And I believe on the application layer, it's better to hear from Eugene since he built some of those applications.
This is my third tech downturn. I was there for 2000 when I was at Amazon, and then 2008 I was at Hulu, and then this time. And though, you know, each one is unique, each of these, there are some patterns that repeat. There's never a bad time to start a company if your idea is sound. Maybe in the past, I don't know, maybe in the past 5 to 10 years, we got a little bit undisciplined, and so it was a fine time to start even a bad idea. Maybe it's not that time now. Well, that's fine. That pattern kind of recurs. When I tell people who are not in tech about how tech works, I always tell them that tech is eternally operating on a series of bubbles. People are always like, tech is, you know, like it's overinflated, the values are too high. And that's actually inherent to tech. If you think about it, you raise money, a seed round, a Series A, whatever it is, and these investors are writing you a check. And if you're successful, it's actually not enough money to get you to whatever. You're going to have to go raise again. Why do they write you that check? Well, they have to believe that someone else is going to write a bigger check somewhere down the road. And then at that round, those people have to believe, well, I can get out at some point because someone else will write another check. So everybody in tech locks arms and says, hey, look, we're all like operating on faith. This is why, you know, if you're a founder and you go pitch somebody and then you find that your deck has been leaked to a whole bunch of other firms, it's actually fine. It happens a lot. Investors talk to each other because they're trying to get a sense of, is someone going to write that next check? Like if I write this check, is someone right? So by definition, this is kind of, it's a little bit of a bubble. It's a bubble of faith. And it works as long as like people keep writing the checks. And at some point you have a downturn like now, people tighten up. And, you know, some of the companies that raised too much in the past few years, you know, they're going to pay the price for that. So, to me, I think it's good. Like every time one of these things happens, I've seen in the past that if you actually are willing to put your head down, be sane, raise a reasonable amount, if you have a good idea, actually now is a better time. A lot of your competition is not going to have any oxygen, or a lot of people are going to flee for the exits. And these are some of the best times to gain a lot of scale and advantage on the competition. So I do think it's worth thinking, though. I was talking recently to someone who runs the venture part of a huge endowment, one of the biggest endowments in the world, and was going over the history of venture returns year over year that they had seen. And we were talking about how odd it was over like the past 10 years. We've had all these like fads in investing. You know, there was like DTC, and then there were roll-ups, and there was VR, AR, and then there was crypto, and there were a whole bunch of these things. And actually not a lot has come out of those. And I think in part it was because tech was being distributed very widely into a lot of industries. And we started labeling everything as tech companies and giving them tech multiples. And in hindsight now, you know, you look back at a lot of these companies and people are like, oh, that company it's not a tech company. And they may have a website, they may have an app, but they're just a retailer. And we're going to give them retail multiples. And so I think it's fine. Like not everything I see is a venture type of company that has tech characteristics. That's fine because in this modern world with a lot of capital, there are many ways to raise money for what you want to do. But I think it's worth reevaluating what makes for venture like worthy investment? What makes for a tech type of venture investment? And there are things that we see that are common among a lot of those things. There tends to be something that generates increasing returns, whether it's network effects or something like that. Maybe it's something that has massive economies of scale on like a global scale because of the internet. But I think, investors are going to have to get disciplined about going back and saying, oh, okay, like we can't just companies or funds were writing checks without any diligence at all. And that was just crazy.
Yeah, there was a period when Thistle was raising early on. It's a food company at the end of the day. And a couple of the companies that raised before us got 10x multiples. But this was a point in 2013 and 14 when any company was just getting a 10x multiple because it was easy. There was money sloshing around, and you could argue, 2021, 2022, kind of the same thing. What's fascinating is, as an investor that kind of looks at the public markets and the private markets, is the venture markets every few years, depending on whatever the new fad is, they're excited. They want to make sure there's obviously FOMO is a huge driver. Yeah. And so they'll come in and they'll say, we'll kind of write the check now and ask questions later because we don't want to miss out. The flip side is the exit liquidity for almost all of these businesses is the public markets. And the public markets are brutal, where if your business model looks like a retailer, of course you're going to get traded like a retailer. And so it's really interesting to see that. And every once in a while, you might see things that are a little bit different. And then, the public markets will actually react the other way. So AI is an interesting example here where, it's the other way around, where obviously venture was early last year in really, propping up a lot of these valuations. And now this year, the biggest driver of the overall public markets is like, the NASDAQ 7 are ripping and the rest of the markets are kind of flat. And so they've really gotten excited and paid a big multiple for that. So it's fascinating to see kind of both sides.
I don't know if it was Joe Weisenthal who said that or something, but how recently everybody's been saying, oh, that was a zero interest rate phenomenon, and everybody wants to peg it to rates over the past while. But I think it was Weisenthal who made this point, and I think it's a good one, that maybe it wasn't the rates. I think post 2008, that crash, a lot of the capital just tightened up in a lot of markets. And the only market that was spending freely continually was tech. And so if you had just a huge amount of capital to deploy, I think there was just nowhere to put it except into tech. And so tech, a lot of the boom times were just because there was just so much money going in, and a lot of other sectors, there was just no money going in. With AI right now, I do think that, the kind of downturn started last year. Everybody was tightening up. Everybody was being very disciplined. There was nowhere to put money. And for a lot of investors, AI was this release valve. It's like, oh, okay, thank God I can write some checks again. And so just like a ton of money poured into AI. And look, like I said, tech runs on bubbles. I mean, a lot of AI things I see probably are bubbly in nature, but that's just the way that tech is.
Yeah, it's fascinating. If you think about 2000 and 2008, those were both cycles where we went into recession. GDP growth was negative. This was the first cycle we've seen, and granted, we're not completely on the other side of it, but it looks like we're pretty close, where it was driven purely by interest rates. It was by inflation, and it wasn't really, the economy slowed a little bit. It didn't slow all that much. The jury's out whether it's going to slow in the next year. But, we had kind of a full cycle without the macro really impacting. And so again, like rates clearly are having a bigger impact. The other side of that is coming out of the GFC in 2008, you just didn't have growth anywhere. The whole world was in kind of a deflationary trap. And so anywhere, if you could find growth, both in the public markets and the private markets, investors really wanted to pay up for that growth. And so tech was the place you found that. Yeah. We're kind of in a similar position right now, but because there's been so much of a fiscal impulse, especially in the US, overall GDP growth is quite healthy. The rest of the world, it really isn't, and China looks quite concerning. Yeah. But in the US, our GDP growth right now is like, nominally it's going to be 6 or 7%, and even real, it's going to be 3%. And so that means that lots of other sectors are also growing, but at the same time, you've got a true potential new platform in the form of AI that really gets folks excited.
Sure.
So Eugene, I think, you cut your teeth at Amazon. I think you said that you were employee number 200 or something. So at a very, very early time, would love to just hear a little bit more about your reflections on kind of what you saw as that business grew, and some things that, the founders in this room could take from that. And also just reflections on kind of the management and kind of how they kind of learned and grew through that process.
Yeah, I joined Amazon in 97, and it was interesting. At the time, Amazon was a domestic book retailer, and we had one warehouse in Seattle. This was our first warehouse after previous warehouse was like Jeff's garage over in his house. So it was interesting to watch Amazon grow up, but maybe it was more interesting for me to watch Jeff grow up as a founder. Since you're all founders, maybe some of this will be useful to you. I was very junior when I joined Amazon, but I was in strategic planning. I was like the first analyst. And so I had to go to a lot of meetings with Jeff just to take notes on our strategic plan and to communicate the plan to the rest of the company. And I think in the years since, we've had this idea of the founder CEO as this mythological, like godlike figure. I think a lot of VCs push this. A lot of the most successful founders are founder CEOs. So we have this like aura around, hey, if you're founding a company, you have to stick around because you're invested with special powers, like holy powers that, and it's true. I think you can pull off things as the founder or CEO that nobody else can, that it's harder for an outsider to do. But I think the damage of this myth or this, it's really, I think of it as tech's version of the hero's journey. I don't know if any of you are familiar with Joseph Campbell and the hero's journey. It's, like Star Wars and all these like stories, and Hollywood reveres the hero's journey. In tech, our version is the founder CEO. The best example maybe is Steve Jobs, because he was evicted from his own company, had to wander in the wilderness. He came back in, was resurrected, brought the company to new heights. It's like the perfect shape of the hero's journey. I think what's missing though is the fact that if you look at all of our most successful founder CEOs, the ones that have run the biggest companies, Bezos, Steve Jobs, Zuckerberg, Larry and Sergey, Bill Gates, you go down the line. At many points along the line, they got a lot of help and mentorship. There's no school you can go to just learn how to be a founder. Jeff didn't have that. He started running Amazon, and many people forget that at one point Jeff brought in a president from, I think he's from Pepsi or Black & Decker or something like that. This guy, Joe Galli, to be president of Amazon. And at the time I thought, wow, maybe Jeff is like, I think Jeff was like, am I like suited to be the CEO of Amazon? Maybe not. Maybe I should bring in a more seasoned executive. And we thought, wow, maybe Jeff's going to step back and just be like chairman of the board and someone else is going to run Amazon. But, those years when he brought in Joe, I think he was able to observe Joe doing different things, and he was learning the whole way. Jeff was really good about tapping into other CEOs and their expertise and asking them about different things. And a lot of those things that he learned were formative. And I think the same about Zuck with Cheryl, or Larry and Sergey with Eric Schmidt, or Steve Jobs having to go, be evicted from his company and, to learn the hard way and then to come back. And if you ask anyone from Apple about Steve Jobs before and after, he was a much more effective and seasoned CEO after he came back. If you think about Bill Gates with Ballmer and other people, like I think it's okay, and you should actually ask for as much help and mentorship from seasoned executives as possible. If anything, I think the short tenures of people in tech has been damaging because, a lot of the most successful people in tech, they make so much money, they tend to just retire. They're like gone. They exit the game or they become investors. In other industries, you tend to have very seasoned executives who stay around for like decades. And, by the time they retire, the next people who take over them are in their 50s or 60s. But what that created was a long, broad sort of mentorship thing that maybe in tech is missing. So many of you may have heard that Bezos at Amazon had this shadow program. He would take a promising young executive and say, hey, you're going to be attached to my hip for, 6 months, a year, whatever. You're going to go to every meeting with me. We're going to fly around. I won't spend a lot of time necessarily mentoring you, but, if we're on the car to the airport, you can ask me questions and whatnot. And Jeff's idea was just, I want to download my brain into you. You can just follow me and watch me. we tend to think of apprenticeships as being a blue collar thing, like you're a blacksmith or a baker or whatever. But I actually think it's very underrated to have apprenticeships and mentors in white collar work and knowledge work. So much of what I learned at Amazon was just being in a meeting with Jeff. I mean, he didn't say anything to me. I was just watching him. I was listening to him talk out loud. It really does help you understand how someone thinks when you hear them repeatedly make decisions in a meeting. And if you just follow someone around, you also pick up all their habits and how they spend their time and just all of these subtle things that I think we do a disservice in tech because we take our top performers, we promote them into management positions. We don't really teach them anything, and we just throw them in the deep end. And managing and being an effective leader, that's a skill like anything else. So I think as a founder, that's just something important to keep in mind. You don't have to be alone. It's okay to ask for help, especially in this era of remote work too, where I think a lot of people are isolated. It can be very stressful. I know that burden of being a founder, and they take everything on yourself. And it can be really brutal. So that's part of it. I would say the other lesson is that Jeff, I saw, always thought of Amazon itself, like the company, as a separate thing from the business. So he was always obsessed with, like, how does the company itself operate? Like, it doesn't matter what business Amazon is in. How do we make decisions? How do we share information? How do we set goals? All of those things. There's this book called Organization as Metaphor, and it has just like a number of metaphors for what an organization is. And my favorite one is thinking of an organization as an organism. So if you use that metaphor, then there is, you're eating things from the environment, or you think of it as like a metaphor for hiring. You're bringing people in, you're shedding waste, and that's like sort of like firing. There's how do you, as like the brain, and how do you make decisions as a company? That's important. And then there's how you allocate kind of energy as an organism. It's just like, hey, where do you deploy capital onto what projects and things like that. And Jeff was like always thinking about each of those very carefully. He would observe, okay, how do we improve what? So a lot of you may have heard of the 6-page memo thing that Jeff had come up with. That was just a meta thing. Jeff thought, we're making bad decisions, and part of why we're making bad decisions is we use PowerPoints to make our decisions, and PowerPoint makes us very susceptible to charismatic speakers and really fluffy ideas. And he's like, hey, if we use memos and we have to read them quietly, and we're not like, the speaker can't stand in front of us and charm us. Well, writing demands a certain amount of logic that will make us smarter as a company. I think 6-page memos have their strengths. I also think they have their weaknesses. There's certain things I would not want to make a decision on using just the memo. But that was an example of Jeff thinking of the meta, like why aren't we making smarter decisions? How do we scale? Another example is, you all know of Amazon Web Services. What made it possible for Amazon to create that as a business? Prior to Amazon spinning out web services to the public, Jeff at one point said, Amazon, we do all these projects, we're in all these geographies, but we are so slow at making decisions because we're so sprawling a company. You have to check in with so many people to like access the search service. You're trying to launch a new retail store. And he's like, we need to decouple things. We need to be able to move in parallel independently. So he made every tech, department document their services and make them available via APIs. The hope was that if you needed to spin up something and you needed like the search browse team, the service, you would not have to speak to the team. You could just go read the documentation. You could just call the service. And that documentation and that whole process led to Amazon being able to then just open that up as a service to the public at large. Again, that was an example of Jeff thinking about, how do I make Amazon operate better? The last thing a story I'll tell is, very early on, Jeff would come up with he would think very hard about, okay, what's the most important thing we have to focus on as a company this coming year? you know this at startups, you have very limited resources and time. You have to, like, one of the most important things is choosing what's the most high leverage thing you can do. Jeff would come up with these plans, then he would share them with the company, and then he would just quiz people. He would ride the elevator with you and be like, hey, do you know what our like most important thing is this year? And he was struck. He's like, oh my gosh, like people keep getting it wrong. Like how do I tell people over and over, this is the most important thing? And he realized that, you almost have to think of it like marketing. If he tells his direct reports, his, the VPs, and then they go tell their team, and those managers tell their team, it's a game of operator. The message is not going to survive that process unless it's very well crafted. So after that, Jeff's like, okay, from now on, every year, whatever our focus is I'm gonna come up with some little saying. It's gonna be one thing, and you'll be able to remember it. And the reason I know this works is because I still remember the theme of each year. When I was at Amazon, it was like a long time ago. And I can't remember the theme from any of the other companies I've worked at, really. So there was one year where, because Amazon's business model was built around economies of scale, that's one of the classic competitive advantages. He said, this coming year, we have to scale. We have to grow our revenue really fast, like at the expense of cost reduction or anything. Like all that matters is we have to sell as many books as possible. He had a contest. He came up with a phrase for it. It was get big fast, baby. That whole year, like every meeting, every all hands, like get big fast, baby. And the baby part was really important because it's kind of stupid, but like it makes me remember it. If it was just get big fast, I don't know if I remember, but get big fast, baby was the thing. And no one forgot that. Like everyone in the company, you asked, what's the theme this year? Everyone in the company, it didn't matter what level, like get big fast, baby. Then Jeff ran into Michael Dell at some conference, and we were growing like gangbusters at that point. And Michael Dell said, Jeff, you got to be careful. As you approach $1 billion in run rate for revenue, you're going to find that everything in the company breaks. And that's because your company is going to grow, and the processes that worked when you were a 100, 200 person company are not going to work when you're at $1 billion. And he had me, because I was in strategic planning, he had me go do a study. And I went, and at the time I was like, oh, wow, it's true. If you look at a lot of very successful companies, they hit $1 billion in revenue and then they have a really bad year.
Did they do the SAP install at that point?
Yeah, that could have been part of it. Anyway, like the thing that Jeff took from this was, okay, the theme for this next coming year, because we're approaching that $1 billion run rate in revenue, is we have to scale our processes. Like every department has to figure out how to handle $1 billion in revenue and run rate. So I generated this fake report that had order volume and everything for every department. It was like, this is the volume you're going to have to handle at $1 billion. And Jeff said, all right, every department, you have to figure out how to handle this volume without growing your headcount linearly. You're going to have to just make do with like some smaller number of people. And that forced, for example, customer service to build customer self-service, because they're not going to just be able to hire customer service reps. And it forced our distribution warehouses to come up with robotics and different things that allowed everything to scale. And the name of that year was GoHio. It's an acronym that stood for Getting Our House in Order. I can go through all of these, but the meta point is you as the founder are going to, you'll always be suffering from what is called the illusion of transparency. You have everything in your head. You're thinking through everything that needs to be done for the company. And because you are thinking it all the time, you think people can just read your mind. They can just like read it off of you. And the fact is, everyone in the company is staring at you as the founder, and they're like, what are we doing? Like, what's going on? They have no idea. They have no idea what's in your head. You're going to find you're going to communicate the same thing 1,000 times just to get it through to people. But if you think carefully about how to communicate that message, you maybe can get leverage and not have to communicate 1,000 times. Maybe you communicate 100 times or 10 times and it'll stick. So those are some of like the big lessons that bubble to mind when I think about Amazon and watching it grow over the years.
Must have been such a fascinating journey.
I wanted to add on something Eugene mentioned about you should get help as a founder. So how will you do that, right? Because it kind of sounds vague. So one thing I do with the founders I get to work with is I try to introduce them to founders who are either at the same stage or at the stage ahead. So if I work with a seed founder, I'm going to introduce them to some founders at Series A, Series B, and some other seed founders. And that founder network is invaluable. And that's something you can do definitely if you have an investor or investor friends. Something that founders forget is that the investor's role is to serve the founder and not vice versa, or the investor to be somebody you report good news to. They're supposed to be your partner and be in the trenches with you. So if I can give one takeaway for home is make your investors do some work for you. Don't be afraid to give them homework.
Second that, absolutely. So Eugene, I had the pleasure of going back and reading your three blog posts, very long blog posts on TikTok last night. And I think you've been really on the forefront of identifying how traditional sort of Western social networks like Twitter and Meta really built a social graph based on connections. And in a lot of ways, TikTok was able to come out of nowhere and disrupt them by building this interest-based graph, along with a lot of other kind of unique innovations that they brought to market. Would love to just get a quick synopsis of that for the audience, and then maybe takeaways on how some of those strategies might affect how folks are building products in this room and how they can, have an opportunity to really grab market share versus their competitors.
When Western social media or social, I'll just start with social, was created for a variety of reasons. They began with people like following or friending each other, Facebook, Twitter, Instagram, all of these. And then once they had that graph, everything sort of was built off of that spine. Like the graph was the core architecture off of which the entire edifice was built. So they came up with the concept of a feed, and the feed at first would just show you things from people you followed or friended, and vice versa. People, if they followed you and you posted something, they would see it. And that worked until your graph got too big. And it turned out, and you were like, oh, okay, the noise in the feed is significant. It turns out not everybody you're friends with, like the things they're interested, aren't always interesting to you. And if the feed is too noisy, then people lose interest in the feed. And this is a global, zero-sum competition for attention. So that's not a good thing. So the next big development was putting an algorithm over the feed to try to correct for that imbalance. So you may have a bunch of friends that you follow on Facebook, but you're not all interested in the same thing. Maybe this algorithm can figure out what you're into and just show you the things you're interested in. And so Western social put that in, and I think that was a huge moment in the West, because that was the moment we went from social networking, or what I think of as social networking, to what we refer to today as social media. Because at that point, everyone became a media figure, because you had to fight the algorithm to get your thing seen by other people. It didn't matter if they were friends with you or followed you; they might not see it if the algorithm decided it wasn't good. So we all became media figures trying to determine what the algorithm wanted and give it that. And it's really interesting, like it feels so native to all of us because we use all of these services. But when China came along and their internet started booming in like 2012, I would go to China every year and meet with different tech companies. Some of my pieces had been translated into Mandarin. So like I kind of had like people over there who knew my ideas, and they would invite me in to speak to their companies. And China's fascinating because in the beginning, China was like, we're just going to copy everything that worked in Silicon Valley. But they were doing it later, and they were doing it post the invention of the smartphone. Western social kind of started just before the smartphone came. It was the laptop, desktop era, very web browser based. But in China in 2012, by then, everybody had smartphones and they all had video cameras. And also in China, most people, they only have, like their only computer is their smartphone. They might have a work laptop or desktop or something like that, but most people in China, their only thing was the phone. And so they quickly realized a bunch of things we did in the West, like they don't make sense in the smartphone era. And so they kind of leapfrogged ahead of us in many ways. TikTok and ByteDance, it's interesting because they came along and said, well, if you look at social, why even go to the point of building the graph, then having an algorithm correct for the mistakes of the graph to create the feed? Why don't we just skip to the algorithm entirely? We could just go there. And ByteDance didn't do that just for TikTok. Their first viral app in China was this app called Toutiao, which was kind of like a algorithmic news app. Like I put news in quotes because it was more like BuzzFeedy in nature. It was kind of this like viral content. And it was all algorithmically generated. When the founder of ByteDance did Toutiao, there were already a bunch of news apps that were really hot in China. And so he was like, well, it doesn't make sense for me to go sign the same news partners to do the same things. Like, this is the meta lesson here that I'm getting to, which is, when you take on an incumbent, you can't do the same thing. They're already strong at that thing. You have to come at an oblique angle. So with ByteDance, they were like, well, let's just algorithmically scrape content and use that instead of having to go sign, the major newspapers and have editors. And that just doesn't make any sense. When they bought Musical.ly, they just ran that same playbook again. They were like, Musical.ly, it kind of topped out, but maybe the problem is their algorithm for their feed isn't good enough. There were a number of other things that they did that helped. But I think that was the biggest lesson to be taken from that. The incumbents in tech right now are very strong. I honestly think if you were an endowment and you went back 20 years and instead of investing in venture funds, you just invested in, like Google, Amazon, like the big tech stocks, they call it the big 10, you would have done unbelievably well. And
no illiquidity.
Yeah, unbelievable. And that reflects, in a way, how strong those incumbents are today. So I think it's important, and it's going to be important in AI too. I know people in AI hate this. Like, people are like, what's your moat? Like, how are you going to do anything building on someone else's model? But these questions do matter in the long run. I learned this at Amazon. I've learned this other places. Strategy is dominant. If you have the wrong strategy, it does not matter how smart and how well you execute, you will get demolished. If you have the right strategy, you can be completely incompetent on execution in any number of things, and you can just roll. And so it actually matters to think these things through. And so, I don't know. That's kind of the meta lesson for me about TikTok. Like, not everybody is building something like TikTok, so not all the lessons there apply. But the fact that they attacked Western social media from a different perspective has forced everybody in the West to adapt, right? Instagram has now a TikTok algorithm. Twitter has a TikTok algorithm. It's like everybody is just like, okay, you adapt to the meta.
Makes sense. Thanks. Oana, as a VC that's focusing on a lot of AI trends and companies in the space, would love to hear a little bit about what you're seeing in terms of, just the market trends, where people are positioning, and kind of advice you might have to founders around that. And also specifically, if there are sort of bars you're seeing for folks to be able to hit seed and Series A.
Maybe let's do a raise your hand. How many of you build in applications, the application layer? Okay, how many of you developer tools? Okay, so fewer. So maybe I'll talk a bit more about applications then and just mention a few things on the developer tool side. On the developer tool side, what I'm noticing is that the middleware gets squeezed right now, in the sense of the foundation model layer at the bottom. They are adding SDKs and dev tools, feature-like and functions from OpenAI and all these things, and just moving up the stack. And then the application layer, people are noticing to have differentiation and to grow faster in revenue, you have to do a lot of custom infra work. And so they are coming also a bit down the stack. And people who used to just call some APIs and maybe focus on the workflow, now they also have to innovate a bit at the model layer and things like that. So the developer tooling layer is more right now focused on stack agnostic. So think about testing, think about ETL. Those things are getting funded a lot faster than the smaller modular things, because the reality is there is a common workflow, but no common tooling yet. So it's safer to play horizontal in the DevTool space. In the application layer space is there are lots of people who are pitching Zendesk with AI, Salesforce with AI, and the reality is Zendesk with AI will still be Zendesk or whatever, pick your favorite company. And so it really has to have some net new differentiation, either some net new capabilities or the user experience. To give an example, there are lots of analytics companies. So, we had like Looker, Tableau, and all of that stuff. And right now there is a wave of people pitching that with AI. And that has been a fantasy for a long time, that you don't have to know SQL or be technical and you can just do your own report and all of that stuff. And I believe many people think about the end result and they think the symptom is the root cause, instead digging deeper into the problem of why is that the case? Why don't we have that today? And partly the answer of that is there is no standard for analytics. So if you're a Looker, you have to know Looker ML. When I graduated, I actually studied machine learning, but I used MATLAB. I didn't know Looker ML. So you have to learn that. And each of these stacks have their own programming languages and different classes. And so churn might mean a different thing for a different company, for a different, in the same company, for different departments. They can mean different things, or the definition can change. And so one exciting area, to give an example of where is net new, is these LLMs can speak multiple programming languages. And so you can now use LLMs to define a standard for analytics, which has never existed before because you had to know all these different programming languages. And so that's one thing that it's net new. The same in the application space about the user interface. We had chatbots, and I laugh when he mentioned if SAP install break Amazon, because I worked for SAP for about 7 years before as an engineer, before I joined venture. And yes, the product causes problems sometimes. But that aside, the point is, we've had chatbots and a lot of, AI is not new. It's maybe new for the people who are just, paying attention to it now. The reason why all these chatbots and NLP work previously didn't work, from an investor's perspective is, you could chat with a chatbot for customer support and they could maybe triage your, the message, the problem you had. But what the chatbot failed to do is to automate part of the workflow that happens after. So there were maybe tens of companies doing support chatbot, but none of them knew what's a unit of automation worth to the customer. Can you actually do part of a business workflow versus just triage my ticket? And with large language models now, there is a way that they can call different APIs and different other systems that it's finally, it seems to be possible to have this cross application communication and automation. There's still problems, but it's finally starting to make sense, I would say.
Great. I think super helpful. Last question on the LLM front. We're clearly in a really powerful kind of transition to a new tech platform in a lot of ways. That's likely going to upset a lot of the existing incumbents and certainly create a lot of opportunities. Eugene is someone who's spent a lot of time really analyzing social. Curious if you have any take or thoughts on what might come out of the combination of social virality and LLMs.
Well, a lot of people are trying, or at least giving thought to the idea of solving one of the classic problems of social, which is the chicken and egg problem. It's in the beginning, you have no users on your social whatever, and so it's very empty and boring, and people are playing with using AI maybe to solve that by, seeding the network with a bunch of artificial thing. I don't know the state of that and whether that's going to succeed. I think there's still some, in my opinion, there's still some desire for genuine human connection that, it'll be hard to maybe replace with LLMs. But more broadly, I do think that if you use WeChat in China, I don't know if any of you do, but one of the things that's very powerful about WeChat, and we talk about in the West, like, Elon wants to build this like mythical X and everything. But if you use WeChat in China, you really can do a lot of things just through messaging, way more than you can do in the West. There's this idea that, wow, like the message interface, just writing text is super powerful. I think of it, like we're here in the synagogue. It's like, it's like the word of God, like the power of where you just like say it and it is so. So do any of you out there, have you heard of this difference between imperative and declarative interfaces? Is that familiar? Okay. For those who haven't heard this, it's this idea that you have imperative interfaces where to use them, you kind of have to like contort yourself to learn how they work. That's most software today. Like if you're using Excel or some website, you're using some app on your phone, you have to figure out, like I have to tap these buttons or I have to like, go find this database. Like that's how I make this thing work. And so I always felt, we've spent the first 20 years of tech largely forcing our users to figure out our interface. That's why, Apple's so successful. They try to make their interfaces easier to use. But LLMs really open the window to perhaps switching to declarative interfaces where it's like, you don't even have to know how anything works. You're just like, look, I want this thing to happen. Just make it like, think about Uber. You're like, look, I want to be picked up in a car and I want to be taken here. And then the app has to go off and go figure out like they got to find cars. They got to find somebody who's like in the area. And they have to like then make that car drive to you and pick it up. But they kind of figure it all out. And so LLMs, they abstract everything to this point where maybe we can just start saying things and the computer will just go do it. And we'll never have to learn anything about any interface or how anything works. This is a massive thing to me. This is one of the biggest like UI revolutions ever. Because I used to tell people that winning in tech often is about picking the right abstraction layer. You don't want to be too abstract. You don't want to be like abstract, like you don't want a competitor abstract above you. If you're the last abstraction layer before the customer, that typically is where all the revenue accrues. And so everybody, like this is the reason Netflix doesn't let Apple TV crawl their interface and just incorporate it because they don't want to be abstracted above. But LLMs potentially, can abstract all sorts of compute services. And it potentially could be like your phone in the future might just be a thing that you just tell it to do things and it like does all of them. Like Oana said, the devil's in the details. Like how do you make that declarative interface actually work on the back end? But, I know a lot of people are working on that problem right now. That's a huge thing. It's not trivial, but if you can solve that, potentially you leap above all other interfaces that exist in technology. And that's why the potential of AI is very interesting to me. And, the people who can figure that type of thing out are going to be very wealthy.
Absolutely. The idea of meta search broadly is such a powerful opportunity, I think, for so many startups. Where I'll use the example of Airbnb if you want to use one. Airbnb provides value two ways. They aggregate listings and let folks list, and they aggregate demand. Now, in a world where everyone's using LLMs and there is meta search for housing or for lodging, in theory, I would guess that 60 to 70% of Airbnb's value accrues at the demand layer, not the supply layer. So you could see that just disappear in a world where there is a good LLM that can go crawl all of the things. I need a 2-bedroom place in this suburb of Austin for these 3 nights. Show me all the requirements. And it'd be fascinating to see what's going to happen there.
It's fascinating to use ChatGPT and then compare it to using Google for certain queries. You're like, they're like crawling the same stuff, but you realize, actually, there was an answer to my search before. I just Google couldn't figure out how to show it to me. And then you go to ChatGPT and just like synthesizes it and writes a couple paragraphs. You're like, oh yeah, that's what I was looking for. It was there. But for everything is, amazingly powerful.
Yeah, the best example that I can think of is, Google obviously has a huge, is created the transformer model, but it was OpenAI that kind of now pushed them to release Bard arguably too early. And the problem with Google here is that amazing technology, head start in a lot of ways versus everyone else, but their business model is potentially very fundamentally challenged because their business model is a 1998 internet business model, which was, I'm going to put ads in between like the 10 most reasonable results for your query, and I'm going to monetize between. Now, if you're in a world where your chatbot can give you the precise answer, like where is the surface area for ads? Like, I mean, Google will do extremely well in terms of market share, but what does that mean for their revenue? It's a really big question.
That goes back to the earlier point again, which is when you want to take on the incumbents, do something that they can't or are unwilling to do. This is a perfect example. I saw this when I was at Oculus, and I like tangentially could see into the Facebook world. The people who run newsfeed generate all the revenue for the company. They're the most political power. So if you do something that comes along and challenges that, it's hard for Facebook to flip, because those people have the most power in the company. They're going to make the most decisions. They're not going to want to do anything that imperils the golden goose. So yeah, that's the exciting part about AI for me. I do think, there are going to be a lot. I've seen a lot of AI companies that raise a ton. I'm like, like half of these are going to blow up like in the next year or two. But that doesn't mean that AI itself isn't super exciting to me.
Absolutely. Oana, anything to add?
No, I think you've asked me last time a question and I forgot to answer. Maybe it's relevant for the founders in the room about Series A. Right. So when do you raise Series A, or I'll give the generic rule of thumb and then try to give a bit more specifics. The generic rule of thumb, what I've seen in my own portfolio, is when the company's got to like 1 million in ARR, they can raise like a 15 million Series A. Valuation on that is around 50 right now. It used to be a lot higher, but that's kind of, I would say, the average. Not every business is the same. So in reality, what are you looking for when you're raising Series A? You're looking for raising capital when you found repeatability, which the product market fit. It's not something that an ARR number could, show that. It's something that you feel. It's something when you get on calls with customers and you realize that the messaging clicks and people are nodding and you're telling the same story and you're talking with the same type of persona, and they want to pay roughly the same and use roughly the same. So you're getting from chaos, research, lab, experimentation, a bit more towards of this assembly line, factory vibe, or where you kind of know what to expect. And that revenue-wise, I think it starts for around like 500K to like 1 million. Indeed, the market has changed. In 2021, you could raise just on eyeballs and some big narrative. Right now, for a Series A, you should have revenue, or if you're in the DevTool space, at least if you haven't captured the value, you should have created the value, and that's community, how many people are on your repo, how many people are using your product. So you can definitely raise right now as well, raise a sensible valuation that's also be beneficial for you because you have to grow into that valuation for the next round. But yeah, it's a good time to raise.
Cheers. I think we've got time for a few audience questions.
Names used to mean something. Now they don't mean anything anymore. Usually the first money, it's up to you how you call it. It doesn't really matter. What matters is the first amount of funding that you're getting should last you till you can raise the next round, which first time you raise based on the team, typically. And the second, you raise based on what you proved you can do with that amount of money. And so one mistake I see founders make a lot, especially in this market where they feel a bit like, oh, it's hard to raise. They raise less than they know they need. So then they get into this tough corner where they have to raise an extension. The amount of ownership is too small for a new investor. Maybe the insider is getting squeezed by their LPs. And so you're in a tough spot where you don't have yet the proof points. So you can raise, but you also need a bit more money to get there for like a couple more quarters maybe. So it doesn't matter what you call it. If you are raising a seed round and haven't raised money before, you'll be able to do it based on the team and the vision. And if there is product, of course, the product, especially for more technical topics. But if you've raised the pre-seed and now you are trying to raise the seed, people will definitely look have you done with the money from the last round? Are you a good custodian of the insider's money?
In AI capabilities. So I'm not really concerned with what you forecast, whatever, but as long as it's like kind of relatively unambiguous whether you're forecasting.
Are any of us deep AI researchers here?
I believe VCs shouldn't be in the business of predicting the future. I don't have a magic globe. Not a witch, a woman, but not a witch. So I can.
I beg to differ, and that's our job. That much, at least. Not that I'm qualified to do that, but I mean, reading the tea leaves from folks that I chat with and Twitter, it does feel like most people seem to think that like this round of improvements based on kind of the sets of technologies and really that transformer model. We can add more parameters, we can get somewhat more advanced than where we are today, but it's not going to take us to anything near what people are calling AGI or ASI or whatever you want. And so it's certainly going to need a lot more to get there. The flip side is, our largest position on the public side is NVIDIA, and it's been a phenomenal stock. It's very cheap, despite what people say right now. And the reason it's doing so well is they essentially are creating the guns and the ammunition for every single provider, every single AI competitor. And they're back ordered for 9 months right now. And so I think just as that compute gets pushed into the market and gets used, and folks like Amazon and GCP and Azure really driving that, I think you're going to see a flowering of 1,000 different business models because it's becoming that available for everyone and everyone's turning it up. And flip side is folks like Oana and others are pouring lots of fuel onto that fire to go buy a lot more compute and learn and test. And so I think, on the technology, the core technology layer, maybe we've got another year to go, but the application side of that, it probably has many years to run. And then you find 1,000 verticals where it can really be applied and then it can really sing. Eugene?
I agree.
Johnny?
Oh, about how Threads is going to do?
Don't we already have the answer?
It's interesting because, I guess it's both fair and not fair that we're evaluating Threads and it's still so early. And I think we forget how long it took Twitter to get just product. It took years for Twitter to become anything. That said, of course, it's a different time. They are able to copy a lot of what Twitter did, so you would expect that the timeline shouldn't take years for them. I think what Threads shows is, I wrote a piece about this recently, and I think what it shows is that it really is true what Mansur Olson said about the inertia of groups, that it's very hard to form a new social network. It just takes so much time to get enough people with critical mass And because Twitter exists as it is today, a lot of people are not going to cross over and switch unless either they're, they're really anti-Elon, or they find that their distribution is better on Threads than it is on Twitter, which for the most established users is not going to be the case for a long time because they already have a following there. And there's always the risk, I think, with Facebook of just like, maybe they just get bored of Threads at some point and just give up on it like they have on a lot of their efforts. That said, I think Twitter going to a more TikTok-like algorithm in the long run is going to be dangerous because it really turns Twitter into this viral contest. Like it used to be you could write whatever tweet and a lot of people that follow you would see it. And now I think most people, because they show the view counts and you can look at your stats and everything, have realized that it's just like doesn't make sense to tweet anymore because no one who follows you sees it unless you write just like an unbelievably viral tweet. And that changes how you use it. It becomes a contest to write really viral, tweet storms about AI or, pithy summary of like some learnings or some talk or some book. And I actually think that in the long run, that kind of seems counter to what Elon wants, which is to build X, which is something more utilitarian, like a network that's more utilitarian. I think it's fun. I think right now it's a good time if you're on Twitter. If you like to write humor, if you like to shitpost, if you're a troll, like those types of things, the returns to doing that are much higher now than they used to be. You get unlimited distribution. But I do think that that's like a short-term game at like a long-term cost to them. I don't know. That said, like Threads, it's going to take a long time, I think, for them to get some sort of critical mass there. So I still think like what I wrote, I still stand by it. Like I think Twitter is in a weakened state, but there's no real replacement for it. Like it'll probably continue to exist as that place that you go write you come up with something viral and witty in your head. You're like, I'm going to go dump it there because that's probably where I'm going to get the best return on that.
But we might get a Zuck Musk like cage match out of it.
That would be great.
On that note, I think we'll conclude today's session. Really appreciate everyone coming by.